course description and units. The time value of money concept is based on the fact that money in the present is worth more than the same sum of money to be received in the future, as money on hand can be invested to earn a return, and thus can create a bigger amount of money in the future. Objectives. On completion of this course, Introduction. The value of money decreases with time due to factors like inflation, future uncertainties and loss of opportunity to invest in better investments. Investors would like returns on their invested money as interest, dividends to compensate the risks associated in receiving the money at a future date. To make investment decisions, one should be able to assess the value of money in relation to time, opportunity of investments and risk associated with future payments. The nature of investments, as well as returns, could be one-time or spread over a period of time. Understanding the time value of money and its impact on debts can help people in make better financial decisions, and will help them to reach their personal and financial goals. For evaluating the value of a sum at different points of time, for various types of cash flows, we need to understand concepts like present value, future value, discount rate, effective rate of interest, annuities, perpetuities, etc. At the end of the reading we will be able to compare and evaluate different investment opportunities based on cash flows using mathematical formulas. Common notations. These notations used for calculating time value of money. Present value. Present value is the current value of an amount receivable at a future date. Due to inflation and other future uncertainties, the value of money depreciates over a period of time. It is the worth of a future amount of money at a specific point in time. Future value. Future value is the value of a current investment at a future date based on an assumed rate of growth. The future value is important to investors and financial planners, as they use it to estimate how much an investment made today will be worth in the future. The number of periods. This is the total number of periods in the investment, usually measured in years, but it could be any scale of time such as quarterly, monthly, or even daily. Interest rate. Interest rate per period by 100. Cash flow. Payment made or received at the end of each period in. Growth rate of cash flow. Growth rate of cash flow in case of growing annuities and perpetuities. Concepts. Before we proceed to understand and calculate present and future values, let us understand a few concepts related. Cash flows. Compounding. Discounting. Cash flows. Cash flow in simple terms is the amount of cash that is generated or consumed in a given time period. Cash flows can be fixed, or of varying amounts, and their value can be positive as well as negative. When you invest a sum in a monthly income deposit in a bank, you will receive continuous fixed cash flows for an agreed period. Compounding. Compounding refers to the increasing value of an asset, due to the interest earned on both principal and accumulated interest. Compounding is the process by which a cash flow today is converted into its expected future value. Typically, many of the bank's deposit accounts and loans are compounded monthly or quarterly or half-yearly, etc. Discounting. Discounting is the process of determining the present value of a payment or a stream of payments that is to be received in the future. Given the time value of money, a rupee is worth more today than it would be worth tomorrow. Discounting is the primary factor used in pricing a stream of tomorrow's cash flows. Future payments received today will be lesser by the applicable discount. Discounting is the process by which a cash flow, which is expected to occur in the future, is converted to its present value. Do you know? 1. Present value is compounded to arrive at future value. 2. Future value is discounted to arrive at present value. Uses of TVM. The concept of TVM is used in many areas of finance, like calculating internal rate of return, calculating annual growth, calculating net present value, valuation of investments, analyzing or comparing strength of projects. Did you know? Why do we prefer a sum of money today to the same sum after 1 year? Because consumption foregone has value. Investment lost has opportunity cost. Inflation may increase and hence purchasing power decreases. There is a default risk, as you may not receive the sum assured. Illustration of TVM. Exercise 1. Types of cash flows. There are 5 types of cash flows. Types of cash flows. Simple cash flow. Annuities. Growing annuities. Perpetuities. Growing perpetuities. Simple cash flow. A cash flow which occur at one time or different time, and can be of different values. Annuities. A constant cash flow that occurs at regular intervals at fixed period of time. Growing annuities. A growing annuity is a cash flow that grows at a constant rate for a specified period of time. Perpetuities. A constant cash flow paid or received at regular time intervals forever. Growing perpetuities. A growing perpetuity is a cash flow that is expected to grow at a constant rate forever. What is cash flow? The term cash flow is used to describe the amount of cash that is generated or consumed in a given time period for a business. Cash flows can occur at different times, and hence their values are different with respect to different points of time. The value of cash flows needs to be adjusted to arrive at a present value or future value of total cash flows. 2 common methods of adjusting cash flows for time value of money are compounding. The process of calculating future values of cash flows. Translating a value to the future is referred to as compounding. Discounting. The process of calculating present values of cash flows. Translating a value to the present is known as discounting. Cash flow is one of the most important metrics in financial accounting, and is very useful in performing financial analysis and managing business operations. A company's strength is assessed on its ability to generate free flow of positive cash flows in the long term. Discounting of cash flows. Present value of cash flows is always discounted. The main reasons for discounting are to adjust for the risk of an investment opportunity. All investment opportunities in business investments do not carry the same level of risk, because the probability of receiving from high-risk investment is less as compared to low-risk investment. Hence we apply a higher discount rate for investments at higher risk and vice versa. To account for the time value of money. Cash received at a later date has the risk of inflation, and the money received today can be invested to earn money. Cash flow statement. A cash flow statement shows how much cash is generated and used during a given time period. A cash flow statement reflects the actual amount of money the company receives from its operations. Example of cash flow statement. Assuming a person has invested ₹1,000 and he receives returns spread over a period of 5 years, the cash flow statement will be like, period year. Cash flow. 0, minus 1,000. 1, 100. 2, 200. 3, 300. 4, 500. 5, 700. Total net cash flow at the end of 5 years equals 800. Exercise 2. Present value. The present value of a future payment, or the time value of money, is what money is worth now in relation to what you think it'll be worth in the future based on expected earnings. We can apply the concept of present value concept in our real-life situations like buying a house, investing for future goals, calculation of EMI, etc. Present value is discounted, as the future amount is received today or received before it is due. We can calculate the present value for a single cash flow using the formula PV equals cash flow into discount factor, or PV equals cash flow into discounted rate by 100. Let us assume that I is the interest rate discounted and R equals I by 100. Future value is equal to the cash flow in single cash flow at the end of period. Cash flow equals present value plus present value into rate factor. C equals PV plus PV into R, or C equals PV into 1 plus R. Present value PV equals C by 1 plus R. Example. PV of single cash flow. What is the present value of a sum of rupees 1,100, which is receivable after 1 year at an interest rate of 10% per annum? Here cash flow C equals 1,100. Interest to be discounted R equals 10 by 100 equals 0.10. Period N equals 1. Here PV equals 1,100 by 1 plus 0.10. PV equals 1,000. Hence the present value of a sum of rupees 1,100 receivable after 1 year is rupees 1,000. The future value is discounted by 10%. Points to remember. Interest rates can be compounded monthly, quarterly, half-yearly, etc. Interest factor R will be accordingly adjusted, and cash flow should be calculated at the end of each compound period. If a deposit is compounded on quarterly basis, there will be 4 flows in 1 year and the rate factor R is divided by 4. Formula present value is influenced by both the interest rate and the number of discount periods. As the number of discount periods, N, increases, the discount factor decreases and the present value becomes less. Similarly, as the interest rate per period, I, increases, the discount factor decreases and the present value also decreases. Inflation is how the price of goods generally increases. The effect of inflation on present value is evident. It reduces the purchasing power of future cash flows. This adjustment reduces the value of future cash flows. Real cash flow equals to nominal cash flow by 1 plus inflation rate. Rate of return is the profit, as a proportion of the initial capital. PV for multiple cash flows. We have understood calculation of a single cash flow. Often there are multiple cash flows for a financial transaction. For example, consider an investment, where interest accrued is compounded and the cash flows grow every year. However, for cash flows with different amounts and periods have to be calculated individually and added to arrive at the total cash flow. Exercise 3. Future value. An investment made may be earning simple interest or compound interest. Future value of an investment depends on the type of application of interest and the frequency of compounding. The difference between the future value with compounded interest and that with simple interest is the interest on interest applied periodically. Future value of an investment with simple interest can be calculated with the formula FV equals PV into N into R, where FV is the future value, PV is the present value, I is the rate of interest, and N is the number of years. Future value of an investment compounded annually can be calculated with the formula, where FV is the future value, PV is the present value, I is the rate of interest, and N is the number of compounding periods. Illustration 1. Insert the graph showing comparison of future value for simple and compound interest. Rule of 72. Rule of 72 gives an approximation of the number of years required to double the invested money at a given annual rate of return. It is assumed that the compounding is at yearly frequency. The rule of 72 is reasonably accurate for interest rates that fall in the range of 6% and 10%. The formula for the rule of 72 for a given rate of return on investment is years to double equals 72 by interest rate. Example. Illustration. How many years does it take to double this per rule 72 and in reality? Did you know? Rule 72 is only due an approximation and gives you rough estimate of number of years taken to double an investment. Effective interest rate. The effective interest rate or effective annual interest rate is the real return on any interest-yielding investment is calculated after taking into account the effects of compounding within the year. Effective interest rate reveals the real interest rate earned on an investment or real interest rate paid on a loan or any other debt. For any deposit or loan, as the frequency of compounding increases, the effective rate increases, and the present value of future cash flows decreases. Effective annual interest rate is arrived with the formula. Example. Effective rate for different intervals. When you take a loan at an agreed interest rate, the effective rate actually depends on the interval of compounding used for compounding as shown below. 10% compounded. Effective rate. Annually, 10%. Semi-annual, 10.25%. Quarterly, 10.38%. Monthly, 10.47%. Daily, 10.52%. Continuous compounding. The concept of continuous compounding assumes that interest is calculated and reinvested into an account's balance over a theoretically infinite number of periods. The minimum compounding frequency we come across is on daily basis. However, on continuous compounding the balance grows by a small amount every instant. The mathematical formula for effective interest rate for continuous compounding is effective interest rate equals e to the r minus 1, where e equals mathematical constant approximately equal to 2.71828, r equals annual interest rate. Opportunity cost of capital. The opportunity cost of capital is the incremental return on investment that a business foregoes when it elects to use funds for an internal project, rather than investing cash in a marketable security. When we want to invest money, we look at various opportunities to invest. Opportunity cost is the profit lost when one investment option is chosen over another option among the available options. The concept of opportunity cost is useful to examine all reasonable alternatives before making an investment decision. To calculate the opportunity cost, we need to know or evaluate the discounting rate based on the opportunity cost. We can use the present value equation to arrive at the opportunity cost. Example. You have rupees 100,000 and chose to invest it in project for 1 year that will generate a return of 6%. Also, there is an opportunity to put your money in fixed deposit that would have generated a return of 7%. Then the 1% difference in return, which is rupees 1,000, is the foregone opportunity cost of this decision. Illustration: how FV and PV change over a period of 10 years. FV of rupees 100 at 10% compounded. PV of rupees 100 at 10% discount. Exercise 4. Net present value. Net present value is the present value of all future positive and negative cash flows during the entire life of an investment discounted to the present period. NPV takes into account the timing of each cash flow and discounts each flow and adjusts to the present value. A cash outflow is an amount paid or invested and is associated with a negative sign. A cash inflow is amount received or disbursed and is associated with a positive sign. Total of all the present values with respective signs is called net present value. NPV equals PV1 plus PV2 plus PV3. PVN. where PVN is the present value of nth cash flow and N is the number of cash flows. Example. Illustration for NPV. Cash flows of a 3-year project discounted at 6%. Calculation of NPV. Net present value is the present value of all future positive and negative cash flows during the entire life of an investment discounted to the present period. NPV takes into account the timing of each cash flow, and discounts each flow and adjusts to the present value. A cash outflow is an amount paid by invested, and is associated with a negative sign. A cash inflow is amount received disbursed, and is associated with a positive sign. Total of all the present values with respective signs is called net present value. NPV equals PV1 plus PV2 plus PV3. PVN, where PVN is the present value of nth cash flow and N is the number of cash flows. All about NPV. Net present value of a project or investment can be positive or negative. Individual cash flows can be positive, but NPV need can be positive, 0 or negative. A negative value of NPV indicates the rate of return of the investment as less than the discount rate or required rate. A positive value of NPV indicates an investment as preferred, and a negative value of NPV indicates the investment should be avoided. The larger the NPV, the safer the investment. While negative NPV may not necessarily indicate losing proposition, it definitely will erode the value, and positive NPV will create value. NPV analysis is useful for determining the intrinsic value of an investment, business or project where cash flows are involved. NPV analysis is used to help determine the worth of an investment, project, or any series of cash flows is worth. Exercise 5. Annuities. An annuity is a financial product that provides certain cash flows at equal time intervals. Annuities are created by financial institutions, primarily life insurance companies, to provide regular income to a client. An annuity can be paid at the end of each period, or at the beginning of each period as shown below. Examples of annuities: car loan payments, home mortgage payments, pension payments, insurance premiums. Type of annuities. There are different types of annuities that are classified based on the frequency and types of payments. The cash flows of annuities can be paid at different time intervals like weekly, monthly, quarterly, etc. The primary types of annuities are: types of annuities, fixed annuities, annuities that provide fixed payments, variable annuities, annuities that allow an individual to choose a selection of investments that will pay an income based on the performance of the selected investments. Life annuities. Life annuities provide fixed payments until the death of a holder. Perpetuities. An annuity that provides perpetual cash flows with no end date. Fixed annuities. Variable annuities. Life annuities. Perpetuities. PV of ordinary annuity. An ordinary annuity is when a payment is made at the end of a period. An annuity due is when a payment is due at the beginning of a period. Present value of annuities paid at the end of each period. Present value of an annuity which is paid at the end of each period can be obtained by adding up the present value of all the cash flows using the formula, where A equals annuity, R equals discount rate per period, N equals number of annuities. FV of ordinary annuity. Future value of annuities paid at the end of each period. Future value of an annuity which is paid at the end of each period can be obtained by adding up the future value of all the cash flows using the formula, where A equals annuity, R equals interest rate per period, N equals number of annuities. PV of annuity due. Present value of annuities paid at the beginning of each period. Future value of an annuity which is paid at the beginning of each period can be obtained by adding up the future value of all the cash flows using the formula, where A equals annuity, R equals discount rate per period, N equals number of annuities. FV of annuity due. Future value of annuities paid at the beginning of each period. Future value of an annuity which is paid at the end of each period can be obtained by adding up the future value of all the cash flows using the formula, where A equals annuity, R equals interest rate per period, N equals number of annuities. Growing annuities. In a growing annuity, cash flow grows at a constant rate for a specified period of time. It can be depicted as where C is the first cash flow and X is the rate of growth. The present value PV of a growing annuity can be calculated by using the formula. The discounting rate for PV calculation is R. Growing annuities, continued. Perpetuity is an annuity without any end. It is a situation where a stream of cash flow payments continues forever. Example of normal perpetuity. Present value of normal perpetuity is where C is the cash flow and R is the discount rate. Growing perpetuity. A growing perpetuity is a series of periodic payments that grow at a proportionate rate and are received for an infinite amount of time. Growing perpetuity can also be referred to as an increasing or graduating perpetuity. Pictorial representation of a perpetuity with the cash flows of C and a growth of X times for a growing perpetuity. The present value of growing perpetuity is a way to get the current value of an infinite series of cash flows that grow at a proportionate rate. It is the present value of a series of payment which grows at a constant rate each period. PV of growing perpetuity can arrive by using the formula, where PV is the present value, C is the value of perpetuity, R is the discount rate and X is the growth rate of perpetuity. Annuity versus perpetuity. Annuity. Perpetuity. Annuity is a series of continuous cash flows of an equal amount over a limited period. Perpetuity is a type of annuity which continues forever. Annuity is for a fixed period. Perpetuity is everlasting. In an annuity, the payment is made or received. In a perpetuity, only cash outflow is there. Future value of annuity can be calculated. Future value of perpetuity cannot be calculated. A perpetuity is an annuity. An annuity is not a perpetuity. Sinking fund. A sinking fund is a fund containing money set aside or saved to pay off a debt or bond or some future expenditure. It's a fund where annual or monthly contributions are made in order to have enough funds to meet a large financial liability in the future. Example: a housing society with 30 residents intends to go for a new lift. The budget of constructing a new lift is Rs. 5,000,000 after 4 years. How much money should be collected from every resident and deposited in the bank every month, which offers 10% rate of compound interest per annum? Exercise 4. Summary. Time value of money can be calculated using variables: future value of money, present value of money, interest rate, number of total compounding periods. Cash flows can occur at different times, and hence their values are different with respect to different points of time. The value of cash flows needs to be adjusted to arrive at a present value or future value of total cash flows. As a rule, we can say that it is beneficial to have cash inflows sooner and cash outflows later. Interest rate, which is the required rate of return, is also called the discount rate or opportunity cost. Present value is the current value of a future sum of money or stream of cash flows given a specified rate of return. The future value, FV, is equal to PV times the future value factor. Net present value is the present value of all future positive and negative cash flows during the entire life of an investment discounted to the present period. There are two types of annuities: the annuity due, where the first annuity happens immediately, and the ordinary annuity, where the first flow happens on completion of first period. The present value of a perpetuity is A by R, where A is the annuity and R is the interest rate. Please click the above Enter Quiz button to check your skills.